you want to build a good portfolio of assets and you don't have venture in it, like you're missing something, right? From a philosophical perspective, it's actually the most important part of that kind of capitalist chain, right? People are actually comparing it to, I think, 20 and 21 deal-making activity. They're acting like sort of this peak to trough of 20 to 21 to now is evidence of a decline in deal-making. But actually, for me, it's sort of just a reversion to more of a mean, right? Yeah. I don't think LPs are really complaining about DPI these days. It's they'll do anything to get DPI. So.
Welcome back to Billion Dollar Moves, your front row seat to the world of capital. I'm Sarah Chen-Spellings, your capital confidant and guide, and today's Billion Dollar Bite is a pretty awesome cheat sheet for private markets. No better way to learn the essence of private markets than from PE portfolio expert, my friend from Brussels, Sandhu, co-founder of Top Tier Access, and now partner at Investors Capital, both built to help family offices back the best in class in PE managers globally. Joel has a rare vantage point. He sits close enough to the market to feel every shift, yet far enough to see patterns that most GPs and founders miss. In this conversation, you're going to learn how LPs really evaluate managers, how they think about market cycles, risk and selection, and why the future of venture, buyout, and secondaries is being rewritten in real time. Whether you're a fund manager, operator, or just someone obsessed with understanding how private capital allocates power, this is your masterclass in a short bite. Let's get into it. Now, to understand today's private markets, you first need to separate noise from reality. Is the industry slowing down or simply returning to normal after years of access? Joel gives us a grounded LP view, not just on market sentiment, but on how he evaluates managers across venture and buyout when the cycle looks different.
The interesting part of the market that we're in now is we're in this stage where everyone's saying, okay, it's starting to pick up again. It's starting to pick up again. You hear it's starting to pick up again. Mm-hmm. Like you've kind of been hearing that for maybe a year.
Yeah.
It maybe is starting, but not to the levels that it was before. What's interesting is people are actually comparing it to, I think, 20 and 21 deal-making activity. And what I find strange is they're acting like sort of this peak to trough of 20 to 21 to now is evidence of a decline in deal-making. But actually, for me, it's sort of just a reversion to more of a mean, right? Yeah. So if anything, we should just be saying, okay, I'm glad that 20 and 21 are not happening anymore because everyone's complaint was that it was free debt, the prices were too high, etc. So that shouldn't really be a benchmark that we should be aiming for in kind of any capacity. So fundraising was very good then. Deal making was extremely high. You should have a little bit of a pullback, I think. If you look at a lot of the levels, fundraising and deal making basically are correlated perfectly. Yeah. I'm guessing pricing is also correlated with that curve. It may be slower in terms of the growth of the industry, but $1 trillion was still raised last year in private equity. Last time I checked, I think that's still a decent amount of money, right?
Just a little more than your bank account.
It's a little bit more. I mean, I think it's less than the PIF have, right?
That's right.
The activity is still fairly strong. The industry is still strong. But once you get to the heady heights of 1.5 trillion in fundraising and doing a deal every week, to go back to a slower pace of life for these maniacs who work in private equity, maybe it feels like a step backwards, but I think it's kind of a normalization in my point.
So you started Top Tier in 2020, Top Tier Access, of course, not Top Tier Capital, not to be confused. But where are we today? Are you seeing more tourist VCs or has that normalized? Because of course we had the 21 and 22 high. Where are we today? Are we seeing folks already exit the market? Or are you still early on in your journey of investing into managers?
Yeah, look, I think here's the thing with this industry is you're buying a product that you have to pay for 10 years. You're not really going to see bankruptcies happen like that in the community of GPs. You need to give them a long time to do their thesis. There are some managers who will have taken a bit of a hit in 2021 because of all of the things that happened. And they need to be given that time to recover as well. So, just because someone is maybe underperforming now doesn't mean that they should be executed from the market, shall we say. But I think fundamental to this whole thing is that because the time periods are so long, and if you have your sort of corporate governance in place as a fund manager and you have a sort of a team and a reputation, it's kind of hard to go out of business at a certain point. If you're a solo GP and you raise some money, then you couldn't do any deals. Okay, maybe then you just return the money back to the investors and go own a coffee shop or something like that. This sort of tourists exiting. That was more in hedge funds, I think. That and they just now have switched back to buying stocks probably, or not following SoftBank into every like big deal. But I think you'll see it after there's been some sort of maybe difficulty in their performance over time, and they couldn't raise their next fund. I think it's going to be more about not raising their next fund.
That's right.
But if you raised 100 mil on a 2% management fee, you have a decent revenue base for the next 10 years, right? It's
Yeah.
So,
well, what we were seeing is, I suppose, we've had earlier vintages, so call it 2016, 2015, 2017, in which they may have paid higher prices in 21, 22.
Right.
And now, it's about time where the dry powder has run out, right? So they're out in market again. And unfortunately, performance hasn't been the way that it's meant to be. Are you seeing sort of questions in performance in venture and buyout? And how do these two compare, just for those that are not in buyout in the way that you are?
Yeah, they're two very interesting but different asset classes. Selection risk is extremely high in venture. The mean return of venture is quite difficult to get your head around from sort of a risk return perspective. Just like in a venture portfolio, a few companies make up all the returns, but then from the actual manager perspective, a lot of the returns come. So if you look at sort of dispersion of results over time, it's extremely high in venture. Everything from 0xing your money to 15xing, 20xing your money on a fund level. That's the sort of main thing with buyout. You're never really going to lose money.
Might get like a 1.8x.
Yeah, I think, look, you want to get a 2. I think that's kind of what you want to get is in buyout. That's the sort of acceptable 2 in 10 years. But still, selection is super important. There are a lot of bad buyout managers as well, of course.
Yeah.
Not to be offensive, but...
So I was with Dominic, who hits the Fund of Funds program for AXA Venture Partners, and he said this: in venture, it is like kissing a lot of frogs to find your prince, but you find out if the prince is a prince 10 years later. Do you agree? Or can you tell pretty early on, like, okay, they're hitting the metrics? What do you think here?
Ultimately, from an LP perspective, your DPI comes in right at the end, right? Your returns come in right at the end. But I think it also depends on, if you look at sort of from a dollar at work perspective, venture managers, they have quite high convictions after 2 to 3 years of a company or 4 to 5 years of a company. And that's when then they have their second pool of capital that then goes into their good deals. I think they have to kiss a lot of frogs, I'm sure. But then if you look at some of the explosive growth in some of these companies, like we're invested in a growth manager. And if you look at some of their portfolio, it's some of the fastest growing companies you've ever seen, like short time to 100 million ARR. I'm not super sure if you need to wait 10 years to get an exceptional return on an asset. But then the question is, the valuation might be extremely high.
Yeah.
But, who are you going to sell it to? If you can't IPO it, there's also that difficulty as well. So you might be sitting on a very cool, high-growing asset that on paper is worth tons of money. But, exit window have completely changed now.
Yeah.
And so, maybe the frog stays like a frog for a while, but he's a very sexy frog. I don't know.
So what makes a good GP and a bad GP? Across the asset classes, I think there are a lot of parallels there. What have you learned in the last couple of years?
Good returns, bad returns.
Well, early on in the game, how do you know?
We like to see a track record, to be honest. This industry is full of like extremely smart people who are very good salesmen. My co-founder and I, when we go to one of these conferences, the first day you're in like Labrador mode.
Okay.
Yeah, you're there and like you're talking to these people and you're like, wow, oh wow. They tell you their thesis, you're like, oh wow. It's like this amazing world of like Willy Wonka's chocolate factory.
Yeah.
And then after 3 days of like not sleeping and having the same conversation 600 times, you turn into a bit more of a Rottweiler.
Right.
You think everything's rubbish. That's fundamentally, it's in emerging managers. It's a bit like investing into a founder, right? It's, you can look at their attributable track record, but you also don't know how important their previous infrastructure was to their performance. I think that's an interesting play.
Yeah.
If they could leverage a massive infrastructure, maybe that is what helped them with their returns. It's very important to have diversification, on that sort of emerging manager level. Hedging against these different personalities is probably super important to creating like a pool there.
You talked a little bit earlier about the exit and liquidity landscape. What are we thinking here with where Europe is?
Over the past couple of years, you've seen bleeding from sort of private equity, more buyout funds into growth. You saw that happen. You could call them tourists or whatever, but that happened. Now, what I'm actually seeing a little bit is growthy kind of funds, almost like rotating into now mid-market. They're calling themselves mid-market because it sounds a bit more buyouty. It's not just marketing either, right? They're actually really focused on profitability on these companies. So I think basically everyone has realized we don't know when the market will be open for non-profitable IPOs, which is basically been an investment assumption for like the past 10 years. Even if like the rates go down a bit more, they're still much, much, much higher than they have been for a long time. That landscape of being able to just, put Uber on, and then wait however many years it is until it became profitable, maybe that will come, maybe it won't. So I think they're very smartly, growth managers are now saying, okay, profitability matters. It sounds silly to say that, but profitability matters. What we're probably going to see then is like growth funds being able to exit to private equity funds. Private equity funds are still very well capitalized. There's still trillions of dry powder. So I can imagine that being a more important exit if they can show some profitability. That could be an interesting route, I think, for growth managers. If we're talking more about sort of that hyper growth, high loss, that is for me an open question. I don't really see how that can be scalable. It will work for certain star assets, of course. But yeah, I think it remains difficult. It's all about profitability now. And so where you saw that private equity like dipping their toe into growth, now growth is kind of dipping their toe into private equity. There's some sort of strange ecosystem being built in the middle.
A note, we had this conversation just after super returns in 2024 in Berlin, but this conversation is still super compelling and valid. I really love this takeaway here, that underwriting and selection is key in private markets. My opinion, we are in a moment where many allocators are feeling the whiplash of a market reset. Illiquidity has become the big elephant in the room, but the mistake I see over and over again is people comparing today's valuations to the absolute highs. Public equities have returned well above 10% annually over the long term and in the mid-teens in the last decade, while many private portfolios simply haven't kept up. There's a real DPI delta in the system here. Distributions in public markets are actually healthier than people perceive, but because we were so over-distributed in 2021, it feels like the opposite today. The pendulum has swung, sentiment has lagged, and that gap in liquidity is driving true discomfort. But discomfort doesn't equal dysfunction. It means you need to pause and look at the true health of your entire position. Not just the headline markups, but the underlying cash flows, the durability of revenue, the quality of governance, and the real path to liquidity. To me, there is still a premium for illiquid profiles, but only if you truly understand what you own and why it deserves to sit in your portfolio through the cycle. Reset moments force us to be clear, and clarity is where disciplined allocators outperform. Next, we zoom into one of the least understood yet most influential groups in private capital, family offices. Joel breaks down why traditional access paths are broken and how decision-making actually happens behind closed doors. This is a rare look at the LP side from the inside.
I think overall people were fairly active in private equity, and that's also why they realized that there was kind of, for a mid-sized family office, there's a bit of a limitation as to how you can do the asset class, I think, properly. I think that was basically the pain point here. And I see it everywhere, to be honest. It's not just, it's mainly just Flemish industrial families that we're working with right now. Basically the same problem. It's very expensive to go via a bank and you kind of over-index to the big names, Blackstone, KKR, fine, but that's all you have access to and it's usually very expensive.
Right.
Then there's sort of local private equity. You can invest into your mate's fund who might do a decent job, but you're often over-indexed to your local geography as well, right? And then the other option is sort of fund of funds, right? Which works from a diversification perspective.
So to create top-tier access into the best-in-class managers in venture and private equity, what does that look like? In terms of structuring. So it sounds like it's a hybrid of a fund of funds, but not really, without the exorbitant fees. How do you structure top-tier access?
The fees are kind of simple. It's basically priced like an ETF. There's no carried interest. 45 to 70 basis points is actually the fee range. So it's pretty economical, shall we say. We think we should get paid for selecting good funds and managing that portfolio. But also, if you look at what sort of double carry does to your returns over 20, 30 years, it's with the assumption of reinvesting, it's an enormous chunk of wealth. The thing with family offices is, right, they're kind of a unique beast. You'll oftentimes hear these wonderful horror stories about subdocs couldn't get signed because they're on a boat in Monaco and
You gotta ask mom.
You gotta ask mum. Yeah, that's always the anecdote that I always say is, right, you hear a full-grown man full-grown man says, yeah, like I really like enjoyed the thesis.
Yeah.
Fantastic, makes perfect sense, but I got to ask my mum.
That's
So
right.
you don't hear that every day. And if you go to like a pension fund or something, I don't want to call them irrational, but not necessarily
Unique situations.
unique. Yeah, and it should be as well. It's their money, right?
Yeah.
You should be able to do whatever you want with it, and
Right.
whatever the decision making process is there, it's fine. But we realize that as to be able to do this as programmatically, you can't really be beholden to those types of dynamics. So what we did was we said, look, it needs to be an LP-GP relationship. We need to have like a fund-of-fund structure.
Right.
But what we do is we bring the investors onto our investment committee. So it's that way it's structured. We have discretion. They can then have a say in what we're investing into. So we do all that work, and then we present to the investment committee. We don't vote, we just present, and then ultimately it's their decision. So I guess you could call it like a hybrid club deal. Structurally, it works the best because if we want to be doing a decent pace of investment, because it's about a program long term, a fund-of-fund structure makes the most sense.
I don't think everybody has the background that you do on Flemish family offices.
Yeah.
And how that is different from, others that are maybe more quote unquote typical of European family offices, if there is such a thing.
Yeah. The one thing to know about this region is there's a lot of money there. There was sort of a very decent industrial kind of heartland in Flanders. A lot of great entrepreneurs who made a lot of good money, but they're very discreet, right? Berkeley Square doesn't exist in Belgium, right? It's people are sort of spread all over the place. I think it's like that in other countries as well. They're quite like a discreet type of people.
Okay.
They're not super flashy. So if I was going to compare them to sort of more institutional, like London family offices, for example, or New York family offices, I think they're a bit more institutionalized generally, just because also the ecosystem is more evolved, in those financial hubs. But then also, you kind of know where to find them, right? You can throw a rock in Mayfair and it'll bounce off 3 family offices, right? That's the kind of key difference. How far along they are in the sophistication of their investment program is probably a bit different. But then also we see it's a lot of newly created wealth from industrial families after the Schengen plan, basically. That's where the wealth began to be created.
So how are they thinking about their wealth? What you're saying is essentially new wealth created, right? In some ways, a lot of first gens as well. But of course, I think as a whole, we are seeing, the greatest generational wealth transfer of our lifetimes, right? Into baby boomer wives that are inheriting and earning their potential, as well as the next generation. How has that influenced their thinking of where to invest and how to invest?
The themes around sort of impact are coming in. Well, that's typically what you hear when you talk about this sort of transfer of wealth. They want to have some sort of connection with it. I think that's something that's important. Whereas, so there will be like naughty lists that you don't want to invest into, right? Even though oil and gas is having a bit of a resurgence, investing into defense is now cool. These things can sort of come up and down.
Yeah.
But I think fundamentally people want to have a bit of a connection with it. I think there's meaning is important for our generation as well. Whereas if I look at the boomer generation, it was a bit more, I don't want to say pragmatic, but more just about generating return in a kind of a sensible way, in a kind of a conservative way. I have no predictability to be able to tell you what it's going to look like in 20 years when our generation takes the keys over. But I would imagine that, some sort of connection with what you're investing into is probably important,
Yeah.
For our next takeaway, we look ahead. Joel shares what sectors and strategies are primed for the next decade, from ventures' role in funding innovation to the explosion of secondaries, to why the mid-market is becoming the most interesting place to create outsized returns. He also touches on AI, profitability, and how GPs are rewriting their playbooks in real time and how they have to.
You want to build a good portfolio of assets and you don't have venture in it, you're missing something, right? Even if what I said earlier about the risk return being quite difficult of that asset class, from a philosophical perspective, it's actually the most important part of that kind of capitalist chain, right? Because that's where you're funding innovation. That's where you're creating new stuff, which even if loads of it gets marked down to zero by the end of it, it's such an important part of the entire sort of, if you believe in capitalism, it's another conversation, I guess. But, if you believe in it, the money needs to be put with people who are creating new stuff, basically. Yeah. In buyout as well, as you get closer towards the public markets, what you're really seeing is just more swapping bits of paper, right? It's swapping shares of a company, which is fine. And it's important for the ecosystem as well. Inherent in that fact that part of the ecosystem is where the new ideas and the new, the next wave of tech comes from. You should be investing into it, right?
So how are you thinking about it? I mean, are you investing into a particular vertical? I know you mentioned there is this trend of solo GPs, emerging managers, but the dispersion of results could be something to think about. What is, again, your initial hypothesis? Where are you putting your checks for venture?
So if I look at the US, it's the deepest ecosystem. So like Silicon Valley is still kind of, world leading, right?
Yeah.
You have the unis, you have that entire venture ecosystem. There are some funds that we've looked at and sort of interacted in the past who have, I don't want to say a scattershot approach, but they have a lot of companies in their fund. Really, then you're getting that sort of power law exposure, shall we say? You're effectively playing and investing into the ecosystem, sort of in the US. I think Europe doesn't have that depth of an ecosystem. It's probably getting there, but it doesn't. I really appreciate Hussein from Hoxton Ventures. He's one of those guys who he'll do a panel and he'll be like, I think there's nothing good in Europe. He'll say something a bit like controversial like that. He's investing only in Europe with that sort of US mindset. And really, I think what he is a very decent like stock picker, if I can use that word. So it's more about there instead of it, because the ecosystem probably doesn't have the sufficient depth, a very selective choice is what's going to be your saving grace there. And then if I look at Asia, it's an even less mature ecosystem, but there are some sort of outstanding names who have historically done fairly well. So I think that's also then more about maybe leveraging a brand or something like that would be interesting.
I want to challenge you a bit. You talk a lot about brand, about access into the best names, and those have had the privilege in many ways to build that track record, right? But of course, the work that I do with women and people of color, not all of them have had that privilege of calling up mom and dad to give me 250,000 or the first few million to start a fund. And yet we are starting to see them outperform as well, those that may not fit the cookie cutter. How would you think about it as an LP in ensuring that, you're just not picking the same names over and over again?
It depends on what the overlay is, like on your investment program. Our investment program basically, despite what our personal philosophical convictions, is really just to sort of generate great returns. From our perspective as an LP, I think it's good to have, there's pressure being put on GPs around diversity, around these types of things. But fundamentally, if what you're trying to do is maximize returns without taking too much risk on a manager level and then all the way down to a company level, as annoying as it is, the people who've been doing it the longest are more embedded into that ecosystem. I would say that my inclination here would be to continue to back the sort of big names that we've been backing, but then it's maybe necessary for LPs to put pressure to make sure that these kinds of issues are solved on that level.
How would that turn out? I mean, you're an LP today, and you've become increasingly vocal, right, about where things should be and all that. How do you see your influence, and what is your message to GPs here?
I would put that as a disclaimer about the amount of influence I have. We're not a big LP, right? We're not a pension fund or a sovereign wealth. These guys are the ones who have a lot of power. They can have a lot of influence as well. But on the other hand, I think that's not an excuse to say nothing either. If I look across our portfolio, I think a lot of the managers are doing fairly decent efforts across this. Well, all of the Nordic funds that we're in tend to have, it's baked into the DNA, I think. So the teams are fairly equitably, split in terms of gender, I would say. But then also, if you look at their portfolios, it's ESG and impact, or, these kinds of ratings. There are also accents in their portfolio. It might not be the main thing that they're after, but I think fundamentally for any of this to work, returns have to be prioritized.
Sure. And talking about strange ecosystems, the other big one is secondaries. What are your thoughts?
Everyone talks about secondaries and sort of LP-led and GP-led, which for me is, okay, I understand why they're both called secondaries, but they're not really the same thing at all. For me, an LP-led secondary is super interesting as this kind of cash management tool. I was speaking to these very smart people this week who know far more about it than I do. They can genuinely see discounts. They can genuinely see, very interesting flow. And if you slot that into an institutional portfolio, it's an asset that's throwing off cash on day one. It's very interesting. And if you have a smart program of being able to sort of recycle often, it becomes a very interesting proposition. I think from my perspective as kind of on the LP side, what you typically see if you're on the smaller LP side like we are, what we're being offered is these commingled GP and LP led, which is actually an interesting product. So basically what that means is, you'll have some of these LP leds, other LPs in funds or, EQT or TA associates, they suddenly want liquidity and they put it up for sale. You can get a little bit of a discount on the value of that. Fine. You buy a bunch of those. Those things are typically more mature, so there's cash coming off. So that's part of the portfolio. But when you're buying a LP-led position, so a part of a fund that's already maturing, logically, some of that value has already been, you've already paid for that value. There's limited upside in that transaction. And so what the secondary funds are now doing is they're putting GP-led secondaries into that. So what that effectively means is a GP, she wants to keep hold of an asset that they really like. So they put it into another vehicle, they get some external capital, and they keep a hold of it for another 3-4 years. For me, that's like basically another primary deal. That's why I think the combination of the two, it is an interesting product. But I think if you want to be a bit more pick and choose and creating your own portfolio, a little bit of secondaries and a little bit of GP-led doesn't hurt. But for me, it's kind of two different propositions. It's kind of a complicated space, but I think that we haven't seen the end of GP-led. I think that's going to become more and more a very important exit route for GPs. It's always been a dirty word, right? A GP-led secondary, a continuation vehicle. They did a continuation vehicle, because previously it was you put all of your struggling assets into something and you would sell it. But now it's kind of flipped, right? It's I don't know if it's because they can't exit their assets or they just want to keep on growing it, right? Like I think GP-led is going to continue to grow. I think it's going to become massive. LP-led secondaries is always going to be a bit cyclical. There's always going to be some interesting demand, but given the sort of dislocation that we had in the past few years, that's why now is super interesting.
Yeah. So as an LP looking at GP-led secondaries, do you see that as a bad news story?
So GP-led is not necessarily at a discount though. The philosophical issue with GP-led can be that I invest into Fund A, right? And the star performer of Fund A, instead of getting sold to whatever Blackstone for like a very juicy number, the manager says, okay, no, I'm going to buy it myself in this. You get an independent third-party valuation. But I think everyone knows, and GPs have told me this, in dark rooms on a cloudy super return afternoon, that they could probably get 5%, 10% more in the market for that asset. But they're still doing a good return. An LP's not really going to complain about 3-4x, right? That's the philosophical tension between those two things. Whether that's a massive problem, I don't know, because if you can also use a GP continuation vehicle to sort of give a bit of liquidity to LPs, I don't think LPs are really complaining about DPI these days. It's they'll do anything to get DPI. So
ending with a bit of tension, just the way I like it. And looking ahead, what vertical are you excited by? What are you looking ahead to doing more of?
Mid-market for me is also a word that has proven its wonderful elasticity over the past couple of years.
Right.
Everyone is suddenly in the mid-market. Mid-market generally is it's the roots of private equity. Maybe that's a bit of a bold statement to make, but yeah, I mean it in the sense that the reason why private equity is a good asset class is because of active ownership. Active ownership is good, and it's easier to triple a business worth 100 billion. If you're an LP and you need to allocate to something that's going to generate you a return, the suite of mid-market funds, there's some really, really great opportunities out there right now.
And are you looking at particular verticals, or are you looking at a wide swath?
Again, the thesis is really for us about being exposed to everywhere that private equity is active. For example, like industrials has had a bit of a rough run. It's always a bit of a rough run, and it's because of the cyclicality of it. But then the combination of tech now with industrials, I think, is a super interesting opportunity. There's loads of automation happening. That's actually, I think, going to be an interesting space.
You mean AI that you haven't mentioned at all? And it's 2024. I'm kind of shocked by this, Joel.
Yeah, I know. Yeah, it's whenever someone says the word intelligence, I get nervous. I mean, AI is actually something that people are rolling out into portfolio companies. It's probably just like a chat GPT wrapper or like Copilot,
Right.
I'm guessing. I don't know, I'm guessing. But I'm saying that's probably a massive productivity gain. I read one statistic about sort of tech funds, right? They're going to be able to generate 20% more margin just from AI, even in massive companies. That's actually a super interesting piece. It's not just about doubling or tripling revenue or opening your TAM or anything like that. You can just add productivity gains by putting AI there. That's interesting. I mean, it's productivity gains. People are also saying that it's not about firing people. It's about, getting people to do more.
And as we wrap this episode, it's clear that Joel has offered a rare and unfiltered look into how private markets really operate. Today, we learned that the industry isn't in decline, but in a healthy normalization, and smart LPs continue to focus on selection, not sentiment. We saw how family offices approach investing very differently from institutions, and why the right structure and alignment matter more than ever. Lastly, we explored where the future is headed, from ventures' role in funding innovation to the rise of secondaries to the increasingly elastic mid-market where active ownership can truly drive value. With that, thank you for tuning in to today's Billion Dollar Bite featuring Joel Sandhu. If this sparked something for you, drop a comment, share this forward, and tell us what resonated the most. Until next time, I'm Chen-Spellings, reminding you to move bold, stay intentional, and keep building your version of Billion Dollar Moves.